Hi, my name is Jeff Witz. I'm the Director of Business Development at Medicus Asset Advisors. At Medicus, we've been dedicated to educating and advising physicians for over 30 years. Over 90% of our clients are physicians, and we feel particularly tuned in to the financial needs of physicians. Now, before we get into today's presentation, some quick disclaimers we're required to give. We are affiliated with a broker-dealer, Osdale Financial Partners, that allows us to buy and sell securities and insurance products for our clients. And we're also registered with the Securities and Exchange Commission that allows us to provide wealth management advice and recommendations to our clients. Now that we've gotten the disclaimers out of the way, today's topic is life insurance. Life insurance is a type of insurance that many physicians need. Life insurance can ensure family members are taken care of, financial goals are still met, and organizations you are passionate about receive significant donations. Today we'll examine the different types of life insurance, which purposes different types of policies might be used for, and provide examples of how to calculate a life insurance need. Let's start with why life insurance is important. What would happen if you were to die prematurely? Would your family still be able to afford the mortgage on your house? Would your family still be able to pay the bills and maintain a certain standard of living? Would your kids' college education still be paid for? Or if younger, how will childcare be paid for? Would your significant other have to change jobs or return to work? Life insurance can ensure these questions are answered and your family is taken care of even if you are no longer around. When considering life insurance, there are a number of different options, each with different pros and cons. The most common forms of life insurance are term life insurance, whole life insurance, universal life insurance, and variable life insurance. Now let's take a look at how each of these types of policies works. Term life insurance is the most common type of life insurance that people get. How does it work? Term life insurance is in force for a certain period of time. Common terms are 5 years, 10 years, 15 years, 20 years, and 30 years. If you die within that term, the insurance company pays the full death benefit to your beneficiary or beneficiaries tax-free. However, if you outlive the term, the policy typically goes away and you do not get your premiums back, nor do your beneficiaries receive any payout. So why is term coverage so popular? Well, many goals that a person wants to protect with life insurance have specific time frames. For example, a mortgage may have a 15 or 30-year payoff schedule. Once the mortgage is paid off, the need for life insurance to cover the balance of the mortgage goes away. Paying for your kids' college educations or childcare usually ends when the children reach a certain age. For college, for example, when the child goes to college, if you have saved adequately, there is no longer a need to have coverage that will pay for it. By choosing specific term lengths that cover specific needs, you will be covered when you most need it and won't have to continue paying for it when you don't. Whole life insurance works exactly as it sounds. It is in force for your entire life as long as you continue to pay the premiums. At your death, the policy will pay out the death benefit to your beneficiaries. Unlike term insurance, whole life insurance and other cash value insurance policy types have an internal cash value account. When each premium payment is made, a portion of that premium goes into the savings account within the policy. In a whole life policy, this cash value account is guaranteed a modest return so the money continues to grow. The money in the cash value account can be withdrawn, you can take a loan against it, or you can use it to eventually pay your premiums for you. Any portion of the money that you contributed to the cash value account comes out tax-free. Any investment growth must be included in your income and income tax paid on it. Due to the dual nature of the premium payments, where a portion pays for the life insurance and the remainder goes into the cash value account, the cost of a whole life insurance policy is often significantly higher than a term life insurance policy. Guaranteed universal life insurance works very similarly to whole life insurance, except it provides some added flexibility. Universal life allows you to adjust your premiums or death benefit if needed. If the cash value of your account can cover the costs, you may have the ability to lower or stop paying your premiums on a universal life policy for a certain amount of time. However, there can be negative consequences too. Your coverage may end if you use up the account's cash value to pay for premiums. In a guaranteed universal life policy, you are typically guaranteed a fixed return on the funds in the cash value account. The death benefit can also be adjusted up or down in a universal life policy to fit your evolving needs. Overall, universal life may be a good fit for someone who is uncertain about their long-term insurance needs or payment capabilities. An indexed universal life policy is similar to a guaranteed universal life policy, except with one key difference. The money in the cash value account is invested and has the opportunity to grow tax deferred with the market, so it acts more like a traditional investment account. Investing the money is a nice feature, but be aware that your returns are typically capped at certain amounts. For example, the cap on the gain could be 8%. This means if the markets return 10%, your cash value is only credited with an 8% return. Another way they may state the cap is as a participation rate. For example, if the participation rate is 80% and the market returns 10%, then your cash value is credited with an 8% increase. While the cap on gains may seem unappealing, one of the biggest benefits of an indexed universal life policy is you can never have negative returns. These policies typically set return floors, often 0%. So if the markets are down 5% that year, your cash value is not down at all since your return floor was 0%. Indexed universal life policies come with some nice benefits, but do have limitations. Variable policies have a much greater investment focus to it. In a variable policy, you can choose much more specific investments like an S&P 500 fund, an emerging markets fund, or a domestic bond fund. These options typically allow you to tailor the investment strategy so it aligns with your investment strategy elsewhere, like your retirement account. Unlike indexed universal life policies, there are typically no caps on the potential investment return. However, there are also no floors preventing your cash value from dropping. Like the indexed universal life policy, the investment growth in a variable policy is also tax deferred. The downside to a variable policy is often the cost. The individual investments carry their own expense ratios, and then the policy itself tends to have some higher fees than other types of life insurance. This type of coverage is most commonly used once all other tax-deferred retirement vehicles have been maxed out and someone is looking for additional tax-deferred investment growth. However, an analysis of the costs compared to investing in a just regular taxable account should be completed to determine if it's the best option for you. In addition to the base death benefit, many policies offer the ability to add features by purchasing riders. Some common riders include a guaranteed insurability rider. This rider allows you to increase your coverage up to certain limits without having to go through the medical underwriting process again. A guaranteed insurability rider is most beneficial when there has been a significant change in your life circumstances, such as the birth of a child, a marriage, or an increase in your income. The accidental death rider pays out an additional benefit if you were to die in an accident. Most commonly, the benefit doubles the payout to beneficiaries if you were to die in an accident. The waiver of premium rider waives future premiums if the insured becomes permanently disabled or loses their income as a result of injury or illness prior to a specific age. Disability often causes loss of income, and the ability to still pay your life insurance premiums may become more difficult. This rider helps in the event you are totally disabled and unable to work. The family income benefit rider is pretty straightforward. In addition to the death benefit, the policy will pay out a monthly stream of income to your surviving family. Other common riders include the accelerated death benefit rider. With this rider, an insured person can use the death benefits if diagnosed with a terminal illness that will considerably shorten their lifespan. On average, insurers advance a percentage of the death benefit of the base policy to the insured. Insurance companies may subtract the amount you receive plus interest from what your beneficiaries receive on your death. The child term rider can be added to your policy and provides a death benefit in case your child dies before a specified age. After the child reaches maturity, the term plan can be converted into permanent insurance. The long-term care riders offers monthly payments in the event you have to stay in a nursing home or receive home care. Finally, with the return of premium rider, you pay a marginal premium, and at the end of the term, your premiums are returned to you in full. In the event of death, your beneficiaries will receive the paid premium amount. When should you consider purchasing life insurance? If you have an immediate need, the answer is as soon as possible. For example, if you have debts that are not forgiven at your death, such as a mortgage, you should consider getting coverage. As an FYI, government student loans are forgiven at your death and don't need to be protected with life insurance. If you have children whose college educations you want to guaranteed are paid for, you should consider getting enough coverage to cover the cost of tuition and room and board. If you have someone in your life you want to provide financial support for, whether it's for a couple of years or their entire life, life insurance should be considered to provide that support. If any of the above scenarios already exist in your life, then you should explore life insurance right away. If you suspect that any of these scenarios may happen in the future, you should consider getting coverage now as well. The younger you are when you apply, the less expensive the premiums will be. We see a lot of early career physicians who don't own a home yet or who don't have kids yet get themselves $1 to $2 million of life insurance coverage now to lock in the lower premiums in anticipation of needing this coverage in the future. So how are the premiums for life insurance determined? Life insurance premiums are based on coverage amount, age, health, birth, sex, and location. Obviously, the amount of coverage you're applying for will be the biggest determinant of the premium. Then your age when you apply. The younger you are, the less expensive the premiums will be. Your health also impacts the premium. The higher health class you are approved in, the lower the premium will be. The lower the health class, the more expensive the premium will be. Birth sex also determines the premium. Life insurance is more expensive for men than it is for women because men tend to die younger. Finally, the state you live in can factor into the premium. Individuals from certain states are considered to be at a higher risk of death than others, and the insurance company factors that into their price. So how much does each type of life insurance cost? Well, there can be different factors that impact the cost, such as riders. Generally, term life insurance is the least expensive, followed by universal and variable insurance. Whole life insurance is typically the most expensive type of coverage. Now let's take a look at a real-life example of how to calculate how much coverage you might need and what that coverage might cost. In this example, this person has $500,000 remaining on their mortgage balance. They have 2 children. One is 2 years old, the other was just born. They want to pay for a 4-year private university. At the current rate that the cost of college has been increasing, we are anticipating the cost of that college education to be $500,000 total for the 2-year-old and $520,000 total for the newborn. In addition to this, they have an existing car loan balance of $25,000. Finally, they want to provide a specific standard of living for the surviving family until their kids are off to college at age 18, which we estimate will require about $3.5 million. When you add it all together, this person has a total life insurance need of a little over $5 million. Now, this person already had $300,000 of term coverage through their employer, which was equal to 1 times their salary. They also took out $1 million of term life insurance when they began their medical residency. After taking this existing life insurance into account, this person has a remaining life insurance need of $3,745,000. Now let's take a look at what $3,745,000 of additional term life insurance would cost this person. But before we do, let's take a look at the facts. This person is 30 years old, lives in Illinois, has no health concerns, and doesn't smoke. They're looking for a 30-year term policy. For a man, this coverage would cost about $175 per month. For a woman, this coverage would cost about $135 per month. Let's quickly take a look at what happens to the cost if this person waits until they're age 40 to get this coverage instead of age 30. The only real difference here is they're 10 years older and as such have some minor health concerns. Now the cost of this coverage is approximately $400 per month for men, $310 per month for women. So you can see the impact that waiting to get coverage can have on the amount you will have to pay each month. Thank you so much for listening. If you have additional questions or want to explore life insurance quotes, please contact us. Again, my name is Jeff Witz. I can be reached by phone at 312-419-3733, or by email at mylastnamewitz@medicus.com. Thank you again for listening, and we hope you'll watch our other videos.